Hi, thank you for tuning in to Russell Investments Market Week in Review for the week ending June 14th, 2024. I'm your host, McKenna Painter. Joining us today with sharp insights into the latest economic trends, our one and only investment strategist, Bei-Chen Lin. It's great to have you dialed in here today, Bei-Chen.
Great to see you as well, McKenna.
All right, let's dive in. What are our latest views on U.S. inflation and the key takeaways from the Federal Reserve meeting?
Sure thing, McKenna. It certainly seemed like the Tooth Fairy decided to pay investors a visit this week. So we had a couple of important data points on inflation, and these data points all showed a picture of inflation coming in softer than consensus expectations. So the first data point we got this week was on Wednesday, which was the core consumer price index or core CPI inflation. And analysts were looking for core inflation to come in at around 0.3% month over month or 3.6% year over year. Instead, it came in at 0.2% month over month or 3.4% year over year. And when we look at the producer price index, which is another measure of inflation faced by producers, so think companies, that inflationary measure on a core basis came in flat month over month. And so this is good news because remember, what the Fed and a lot of other central banks have been trying to do is to get inflation back down towards its target. And earlier this year in the first quarter, there was a bit of a slight setback. But this week, the core inflation data that was released both on the consumer side and on the producer side points to an encouraging sign that we are once again headed down the right track in terms of inflation being on a path down towards target. Now, the Federal Reserve this week still decided to leave interest rates unchanged at their meeting because ultimately they want more confidence. They want to be extra confident before they start cutting their interest rates. But we think, based on how the data has been evolving thus far, we think that the Federal Reserve will likely be in a position to be able to make their first interest rate cut in September of this year.
Fascinating. Well, fingers crossed interest rates can start coming down soon. Okay, looking globally now, what are the watch points for central banks outside of the U.S.?
Sure thing. So, in terms of developed market central banks, a lot of countries have been facing this challenge where central banks have had to raise interest rates significantly in order to bring inflation back down towards target. And we are seeing trends that outside of the US as well, inflation rates in many countries have come down significantly from their peak. And so that is why we think that many central banks will be in a position to cut interest rates this year. We already saw the ECB and the Bank of Canada earlier make their first cut. And we think that some of the other developed market central banks, like, for example, the Bank of England, will also be in a position to make its first cut later this year. Now, the Bank of England actually has a meeting coming up next week. But the thing is, they had a little bit of a setback in their inflation numbers last month. And even though they're going to get their latest inflation print next week before their meeting, the market seems to think that it's probably not going to be enough to have them to start cutting rates immediately. But if the inflation data comes in line or softer than consensus expectations, then it will make them pretty much on track to potentially lower interest rates at their subsequent meeting in August of this year. So all in all, we are in a situation where globally many central banks will hopefully be able to normalize interest rates, bring down the cost of capital, and that would be a welcome sign for a lot of investors worldwide.
All right, sounds like we're all going to be waiting this summer for some answers. China, they recently released their inflation data. What is it telling us about their economy right now?
Sure, McKenna. So the latest Chinese inflation data shows that price pressures in China are still relatively subdued. Prices were basically around flat month over month or slightly declining month over month. And what that tells us is that there are some ongoing questions about economic growth prospects in China. But overall, we think that the government in China is still very much committed to achieving that growth target that they have set of around 5% for 2024. And we think in order for them to do that, they will need to continue to roll out new stimulus measures. Throughout the course of this year, we've seen the Chinese government step up the amount of stimulus that they've been doing. We think they still need to do more, but the fact that price pressures remain relatively muted for now means that they have the room to be able to do those stimulus measures. So we are cautiously optimistic that they should still be able to hit that around 5% growth target for this year.
Wow, a lot to soak in, especially about inflation. Unfortunately, folks, that's all the time we have today. Until next time, stay informed and invest wisely. We'll see you next week.
Hi, I'm Sophie Antel-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.